Folks, welcome to CFO Chat. As always, your front row seat with the Chief Finance Officer anytime a corporate action has happened. Half year is here, bank numbers are rolling, and as always, the first kid on the block, Stanbic Bank. And guess who's on set? None other than Dennis Musau, now a regular on this platform. Dennis, always a pleasure.
Thank you.
Karibu sana.
Thanks for having me.
Dennis, congrats on the numbers.
Thank you.
First, the momentum is quite compelling. If you continue with this momentum, you are blowing your performance for last year by some good margin.
Yes, and thank you for that. This is the third year of our current strategy. And it's a strategy that we have executed ruthlessly and with a lot of precision, focusing on how we transform our client experience, focusing on our internal operational efficiencies and risk management, and focusing on sustaining our returns. Now, this is the strategy that in 2021 gave us a 37% increase in our profitability. And 2022 returned 26%. So the 47% you're seeing this year is not foreign. It's just that momentum that is building up. And our excitement is that as we go into our 2024 to 2026 strategy, we have a strong platform on which to build.
Dennis, looking at your books, I noticed that you are almost leveling up your loans and your deposits. And whereas I know you would argue, look, we have a diversified resource envelope from which we lend, I'm just wondering whether you aren't exerting too much pressure on your deposits.
I want to grow our deposits. We want to grow them, and we are focused on growing our deposits. But we are operating in a market which, over the last 2 to 3 months, has seen unprecedented or fairly squeezed liquidity. And there are various factors to that. Number one, you've got rising interest rates. What happens with rising interest rates, beyond a lot of things that happen, is a chase for yield. So we've seen some of our customers, especially in the corporate area, chasing for yield and looking for opportunities elsewhere, and that's fine. We support that. We'd like them to succeed as we succeed. And then the second one, which is year defining, is that for a long time, oil in this market was bought in FCY. Now, with the current arrangement, there's more demand for Kenya shillings. And because of that, then we've seen, and because of the way it's arranged, that money is going to sit somewhere in an escrow account. So we've seen some of these customers withdraw. So those customers are doing three things. Number one, they're withdrawing the KES liquidity to show up that. Number two, they're drawing up on their funding lines. And therefore, the loan asset pipeline is growing. And number three, some of them are switching their FCY facilities to KES. And of course, with the current exchange rate, that value is higher. So because of that, we've seen a little bit more stress that would like. When we last spoke, I told you our sweet spot for this is about 80 to 90%.
Correct.
We've now gone above 90%, and we would like to get it back. It's not a concern for now. We have strategies to deal with it. And in fact, as we speak now in August, we've started to see better outcomes out of that ratio.
Speaking about the oil sector and the reconfiguration we've seen in this market ever since March, I was looking at your line in terms of letters of credit. I thought I would have seen a lot more uptick on that side based on that, but I didn't seem to see it.
It's still in the works for us. We haven't yet issued instruments for that. There's some tidying up we're doing on the documentation. We think this is going to be a long-term play, and therefore it's something that we'd like to ensure that we cross the T's and dot the I's in the paperwork. But we are there. We've gotten most of our experts involved in how we structure this and are able to see it through the first 6 months, because I think there's a lot of excitement about the first 6 months. But we see this as a significant shift in how business is done in that sector. And because we are a significant player, we would like to participate in a sustainable way. So we've been slower off the blocks, but we're going to come, we're going to be participating in that space and looking forward to seeing that soon. So probably the next time you see a set of numbers, you could see a shift there.
And still going back to the issue of loans and deposits.
Yeah.
I was looking at the numbers and I thought, we've always known Stanbic Bank to be a corporate outlet. It increasingly looks like it is also catching on with the retail rush that we see in this market. Would it be a fair characterization to say you are really re-angling the bank?
Our balance sheet is 60 to 65% corporate. We would like to grow a holistic financial services organization that includes as many players and as many customers in the market, but grow responsibly. So currently we're still largely corporate. We are growing into the SME sector. It is a personal excitement to see what we are doing in the SME sector. Drawing 22 billion in the first half of the year in that sector is for us very, very exciting. And we are continuing to do much more in that SME sector, in the corporate sector, than we've done before. So are we re-angling? We are following the growth vectors of the market. We are seeing SMEs as the bigger players, the more sustainable players in growing this country into the future. And then, of course, we've always been a very strong private and executive bank. And we are leveraging on that to also reach out to other areas of the retail sector, which we haven't necessarily lent to before, or we haven't interacted with before. So we are a balanced bank, but I would say we're still largely a corporate bank on the balance sheet today.
Okay. And still on that question, from a NIMS perspective, how do you think the bank is looking now in terms of what really defines it?
6.2% NIMS, half year. Our best performing business being the SME business, which is the business and commercial kind of segment, and for good reasons. Those customers are really concerned, and their real demand is mostly about how fast you can get the facility and how quickly they can get the facility. And because they're doing good business, we are able to facilitate with them at a good price. Our corporate business also doing very well, although customers there tend to be on both sides of the curve. The assets and the liabilities tend to be price sensitive. So on that side, it's more of a volume game than it is a pricing game or a margin game. And then on the retail side of things, because of the private banking, again, very, very sensitive customer. These are the CEOs and the shareholders of the corporate customers, so also tend to be very savvy. Some of them actually with corporate desks, or treasury desks that look at their wealth. So not diminished, but also not very expanded. But when I look at the whole continuum, 6.2% in NIMS, industry at 5.6, 5.7. For us is very exciting because we were always below the industry. So we've put in the sweat to try and bolster our pricing of instruments and to try and manage our cost of funding. Our cost of funding was very high. 3 to 4 years ago, we've let go of expensive funding over time to try and rebalance that view. So really excited to see NIMS above industry. Now I'm careful, and we are careful to ensure that we don't manage these 12 faults. And some of the tactical decisions, speaking to the liquidity discussion that we just had, might be to price up in the short term for some of the some of the liquidity, of course, without overly compromising on our NIMS.
Okay. On the asset quality side, I notice your provisions are up ramped up quite significantly.
Yeah.
2.1x
Yeah.
relative to last year. And I just wonder, considering we are seeing improvements in the asset quality, and I'm wondering if the player in the industry whose NPL ratio is in the 9% is doing 2.1% X. I shudder at where some players will be playing at.
Yeah.
But is this an indication that you are seeing potentially a lot of cascade from stage 2 to stage 3 in your books?
So let me explain this in 3 parts. Number one, our NPL ratio is a function of many factors. Number one, it's a function of who we bank. We're really keen and careful to bank customers and not to bank projects, or to bank events. So that allows us to really vet the character of the customers and sometimes we get it wrong. That's why we're at 9% anyway. That's why we're not at 0. And in fact, NPL, this non-performing loans business has been there since the Bible times. I do remember my pastor mentioning a guy who had to be forgiven some loans in the Bible, 200 shekels. And according to in monetary terms, that's a lot of money today.
Yes.
It is a reality of life. Okay? How do you protect an organization from this reality of life in this kind of market? The first thing is vetting your customers. Number 2 is intimately staying close to your customers, understanding their journeys and understanding when things are not going well, because at some point things might not go well or as planned, and being able to navigate that. And the third one is a collections capability. We've bolstered our collections capability, invested in systems that allow us to collect more efficiently. But then fourth, and partly why you see that 9.2, is we take a view on customers that we think we won't recover, and we write off some facilities. Yeah. So we wrote off in part 1 or 2 names, partially, not entirely, to the extent that we think we won't be able to recover. And that helped our NPL ratio come to the 9.2%, which we would think is the right spot and on facilities that we will be able to recover. The second part to your question is, in a market that has elevated inflation, elevated interest rates, a currency that is depreciating, and operators in that market will go through seasons. Yeah. And that is what is reflecting in our provisions. Now, when I look at it through the cycle, our full year CLR last year was 2.21%. Today is 2.18. If at the end of the year I finish at 2.18, I'll have done better than last year. So it becomes a timing difference in that last year, some of the names that are really we're booking impairments on, they caught their cold towards the second half of the year. And as we work through the milestones, we take provisions as and when necessary. Number 3 is, I'm not necessarily worried about stages, a name that is in stage 2, a name is in stage 3. What for us is very, very important is to ensure that we take sufficient provisions for the names wherever they are. Whether they're in stage 2, whether in their stage 3, based on the methodology which is driven by IFRS 9, we take sufficient provisions. And we will not shy away from that. And what else is important, and I have got some news in July that I can't share, is that some of the names we've written off before, we've continued to work through, and we are recovering, even in this environment. So it is that balance. We take the provisions when it's necessary and go through the recovery.
Dennis, speaking about asset quality and FX, we have seen the shilling significantly roiled, trending close to 150 to the greenback. Yeah. And my question to you is, when you look at your asset quality, what sort of exposure do you see, at least going to the end of 2023, principally stemming from the depreciation of the local unit?
About 55% of our NPL facilities are FCY, are foreign currency. If I go back to a year ago, and I freeze where the currency was, and I say, if I exchange them at that currency, my NPL ratio would not be 9.2, probably be 8.6 or 8.7. So there is a 50, 60 basis points that is sitting there. But we have to look at the bigger picture. So I show that statistic, and then we look at it in the context of our purpose, we look at it in the context of our business model. The reality is we have historically set ourselves up as a corporate bank, or a bank that serves corporates, and particularly in sectors that historically called for FX, oil and gas, agriculture, multinationals, and those do call for these facilities. So while the ratios do indicate that there has been a depreciation, our job every day is to wake up looking at what is happening to the cash flows in the right currency, right way matching, of that customer, to ensure that if they are exposed to dollars, their revenue is also coming to dollars. Because look, if you have a loan that is in dollars and in the book it has depreciated, but you're exporting and you're receiving dollars, your problems are not that many. So our principal approach is to ensure that we don't have a lot of wrong way risk, i.e. mismatched currency between revenue and the facilities, and more importantly, staying very close to the business so that if there is a cycle change, what do we do? We've seen actually some of our customers, since the FCY rates have been going up, we've seen some of our customers come and say to us, look, I would like to convert my loan from dollars to Kenyan shillings, because the benefit that I was getting out of the low rates in FCY no longer apply. It's now 6, 7, 8%. And we've worked with those customers to convert those facilities into Kenyan shillings at the appropriate.
I was listening to you, Dennis, and I felt a bit conflicted. So on the one hand, you and the leadership team are telling us we feel like we're turning a corner. But when I look at how you're ramping up your provisions, then it sends a signal that, my friend, we are seeing credit risk being amplified going forward. How do you reconcile this two?
We are turning a corner of what risk? We are turning a corner of opportunities, right? I think the last 2-3 years we've seen, there have been a lot of noise, and if I can just pick FX, for example. Last year when we spoke, there was a lot of media reporting about currency shortages and stuff like that. We're seeing that kind of tapering, and that is informed by the margins, which we've seen kind of calm down. In the last, I don't know, going to 18 months, we've seen rates in the US just going up and up and up and up. I think we are at a point where we're seeing that peaking, and potentially even in the local market. Over the last going to almost a year, we've seen our inflation at above what the central bank kind of has set as a band. We've seen that come back in July. So we're turning a corner of opportunities. That doesn't mean that if you had historical baggage, that baggage is not going to come through. And actually, some of the names we are taking impairments of are not, in fact, not some. Most of the names that we are taking impairments of are 2016, 2015, 2017, 2018 credit. So they are historical names whose business models have either significantly been impacted, some of them irreversibly, so something changed either in your supply chain or in your market dynamics or in law or whatever dynamic that affects your business. And we have been in this conversation about how do we help you navigate? Can we give you additional funding? Can we restructure? And we are at that point where we look at each other and we say, things are getting tougher even as we try and we walk you between ICU, HDU, and the general ward. And maybe it's a time that we actually do some surgery on this, and that surgery means some impairments on the P&L.
Okay. And still on the macros, how are you addressing your exposure to the realities we are seeing in the fixed income market? You know how the yield curve has behaved in the recent past. As of the last auction, we saw it's potentially going to an inversion as we speak, and questions are being raised about your assets as far as government securities are concerned.
We're not worried about the government. We're not worried about the government. I think we are very close to the government, and we're working very, very closely with the government. I mean, when you are a significant player in a significant sector of the economy, you cannot start to doubt your partners, and you cannot be the leader in panicking. So we are working with the government very, very closely to find solutions to these actual or perceived problems or challenges. And we think we are central to the solutions, and not central to defining and explaining the details of the problems. The reality is the future of Kenya will be defined by the policymakers of today and the market players of today. Now, if we have an opportunity to be on that table, we need to be doing the right thing and not panicking. So, I mean, in terms of our book, of course, we apply a lot of, and we pay a lot of attention to where we deploy capital. And I've said this before to you, that government securities investment for us is a liquidity play, mostly a liquidity play. In fact, when you look at our balance sheet between December last year and this year, you almost see a contraction.
Yes.
And it is in customer deposits, but you can almost follow it to trading securities. What's happening there? When we get transient liquidity, we'll deploy it to the trading securities line, government line, mostly on the short term, as those transits to the client franchises. We would like to spend more of our capital on the customer asset side of things, which we've been seeing increasing. But that is not the only way we interact with government. We are a big advisor to the government, and that is something that we'd like to jealously guard, because it is our responsibility to do it.
Okay. And maybe just on that point, and I had to make reference to the numbers because I was combing through them this morning. When I look at the numbers and I'm seeing government securities held for dealing purposes down from 3 billion to about 300 million, that's quite a significant drop, as well as those available for sale from 31.9 B to 23.2 billion. Would you say this is part of the liquidity play, or is actually Stanbic just taking a strategic position in light of the risks that are in the market?
If you go a little longer, so our total portfolio of government securities in June last year were about 54 odd billion. In December, they had gone all the way to 83 billion. Did we have a different view of the government? No. Today, they are at 52 billion. Now, if you pierce through the various classifications at IFRS 9, you will see the most affected is the trading securities, which is exactly what I'm saying. Yeah. When we get these transient instruments, we place them there as a liquidity play, and then when the customer franchises, which is what we would like to see growing. Now, if I paint a picture of the customer franchises and why we are, that it is an exciting story, 185 billion in December 2021, 217 billion in June 2022, 235 billion in December 2022, 244 billion in June 2026. So despite, the play between deposits and government securities and all that, the line that really matters, which is where we are funding SMEs, we are funding projects, we are funding corporates, we are funding individuals, that is the line we're tracking and continues to grow steadily. And
you did mention in the briefing that the proportion of your book, which is now on risk-based terms, is about 63%.
68 for retail.
68 for retail. To what extent or over what horizon do you think now you'll have this fleshed out to 100%? And I'm asking that with full recognition that even in the environment where we were under rate caps, there was still a bit of risk being priced into lending.
So all our book is on risk-based pricing.
Okay.
Everything is risk-based. We look at you as a customer, we agree a price based on time value of money and credit risk, which is what interest rate is all about. But there is what has been, negotiated and agreed and approved by the regulator, and that is what we are referring to. The rest of the book is on an internal model, which is actually also market linked and reflects risk. Do we see a 100% to 0%? It's unlikely to get there. Why? There are some of our customers, especially in the corporate arena, who have treasuries as deep as ours, and they would like to see their cost of funding tracking alongside maybe the T-bill. And the price that they will get out of that is actually much lower than what you would offer in RBP using risk-based pricing. So for those customers who will have one-on-one conversations, and then would be able to price them. The second part is we have a significant FCY book, which is not part of this. So we will not be able to see 100% of the entire book, but where applicable, we keep on pushing the envelope to ensure that all our customers are on a uniform pricing. We like the pricing that we are applying now because it's sensitive to certain aspects of the markets that matter, including cost of funds. But then two, which is very important, is it puts the power in the hands of the customer to determine their prices, as we discussed before.
All right, let's get to the tail end of this. SBG numbers.
Yeah.
Looking quite good. My suspicion, I could be wrong, is this the Diageo transaction showing up? And in the event that it's a one-off, how do you sustain this momentum?
When you've built a business such as SBGS, the reality is every so often you will have some massive transactions, and it's not happenstance. It's really the reality of having built capabilities that allow you or allow our business to manage what I consider the big, or what we consider actually the biggest transaction of this kind on our market in a long time. Our SBGS business is anchored on three broad perspectives. One is the day-to-day intermediation of facilitation of equities and bonds trading, and that's going well. Although the market, excluding that transaction, the market is really down, 32% year on year till June. So that business has continued to have some challenges, or that aspect of the business. But that is one business that we continue to gain market share, although of a smaller pie. But I'll always keep on reminding you that we're gaining market share. The second part is then this ability to manage big transactions. And this is not a one-off per se. Yeah. If you remember in Q1 last year when we spoke, we had just intermediated MTN in Uganda. And the year before we did another one. So it will not always be an elephant, but sometimes it can be a buffalo, sometimes a wildebeest, sometimes a fat antelope, but there's always an animal for the feast. And that is a capability that we would like to continue building. What we are realizing, and feedback we've received from the market, is to say, offer us more capabilities. And we are now building an investments vehicle in the form of an asset management business. So that's going to be coming up in a short while. And we are looking to build from there, to increase our financial services offering, which is already expanded, but would like to expand it more, so that when you come to Stanbic, you really get everything that you would like to get. Maybe if I digress a little bit and go back to the bank. We're coming to the market with an omnibus lending solution. We do realize that our customers, we've seen customers default, and when we follow through, we realize these customers are not in the class that set out. Remember I told you there are three types of customers in the NPL. There are those that end up there by accident because something happens to their business. There are some that go through a short-term winter that you navigate and then you get out of it. And then there are some that borrow with the intention of never paying. And those characters are there. Now, we realize there are a lot of customers who end up defaulting, not because of their intention, it's because they are not they are not cited on all their credit bouquet. What we would like to do is avail to you on one platform your ability to lend. So that we say to you, Julian, you've got a mortgage facility up to 20 million. You have a card up to $500,000. You've got a car loan worth 5 million. And when you go and draw down the home loan, it reduces the other limits. What that does, it allows you to manage your financial affairs as opposed to maxing on everything, which is product-based. And then all of a sudden you realize, oh, and by the way, I have a family to feed and I have school fees to pay, and now something has to give. We'd like to guide our customers away from that. And that speaks to our purpose. It goes back to our purpose. Kenya is our home, South Sudan is our home. We drive our growth. We don't drive growth when we are predatory. We drive growth when we invest in your success and our success.
Two final questions. One is that the central bank has now rolled out the DAO CSD. And essentially, it has been said, democratizing access to fixed income assets.
Yeah.
How do you view this? Because this is a space where players like yourselves have been in.
It is actually very positive for us. Of course, there will be customers that go and open their accounts directly, but mostly, and this has been phenomenal for us, we are seeing more and more customers as, saying to us, we like your platform, we would like you to avail these bonds on our platform, and would like you to open the account through you. So this is actually going to be very, very positive for our customers and for our business. And we are already seeing that benefit. My only, hope and prayer is that, the mechanism holds, and because now you realize there's quite a bit of system integrations. You're moving money from the banks, you're putting it on the SBGS solution, and then it has to integrate to the clearer. That whole integration needs to work for a good client experience. And yes, again, if you pierce through our individual, purposes and look at the bigger economy, you're democratizing this and becoming easier to invest for everyone, and would like a lot more people to invest. The president himself is popularly being quoted, encouraging people to save and invest. Okay,
final question.
Yeah,
I was pleasantly surprised by the dividend. Many of our conversations begin from the dividend. I said this one had to be the last one.
Yes.
I did expect it, but not just what I saw, and especially given the sort of abundance of caution we're now seeing coming from the industry. Just walk us through that decision.
So our dividend increased 100%.
Correct. That's why I was pleasantly surprised.
We are very excited to be paying a dividend in this kind of market conditions. Even more exciting is that we have just paid in June the full year dividend for the year 2022.
Yes.
What is more exciting is that our Stanbic Holdings share, has appreciated the most of of this industry since January this year. We couldn't be more happier for our shareholders. Why are we happy for our shareholders? Because these are capital owners. And capital owners have options of where to put their capital. And therefore, every opportunity we have to pay something back to them, we'll take that opportunity and then take the benefit of all the other benefits that I've spoken to. But we don't make a dividend decision. A dividend decision is not a political decision. A dividend decision is informed by balancing the needs for growth, balancing regulatory capital demands, and balancing shareholder return and expectations. And if you look at our capital, which I showed and is adjusted for dividend, it's it's 13.9 at core against 10.5. We feel 340 bips is sufficient for us to continue growing. For total, it's more than 17%. Against 14.5%. So we have sufficient buffers. And yes, payment of dividend helps with ROE.
All right. Dennis Musau.
Thank you.
Thank you so much for your time.
Asante.
Always appreciate it.
Thank you, sir.